Welcome back to The Explainer. Look, we are doing a real deep dive today into a machine that pretty much every single one of us feeds our money into, but almost nobody actually understands. Yeah, we're talking about the 401k. Today, we aren't just giving generic financial advice. We are going to actively reverse engineer the financial sector's business model. We're going to uncover how wealth is actually generated, how it's secretly extracted from you, and most importantly, we'll decode the exact strategies that elite investors use to navigate this whole system. So get ready, because the mechanics we unpack today are going to fundamentally change how you look at your financial future.
Here's the roadmap for today's Explainer. We'll start with Part 1, the retirement illusion, to look at the shocking reality of American savings. Then we'll expose Part 2, the hidden engine. After that, we'll track the math in Part 3, real-world wealth leaks. Finally, we'll wrap up with Part 4, the elite playbook. Let's get right into it.
Part 1, the retirement illusion. Okay, let's dive into this. We really need to start by peeling back the safety net and confronting some startling data that completely shatters the illusion most of us have about retirement security.
58%. Just let that sink in for a second. 58% of Americans 65 and older have $100,000 or less sitting in their 401ks. And honestly, a lot of them are clustered right around the 50,000 mark. Zoom out to the broader population, a 2025 analysis shows nearly 80% of all adults have less than $100,000 saved up in total. So why the huge disconnect? Well, you can blame behavioral nudges like auto-enrollment. You know the drill. Your company auto-enrolls you at a 3% contribution rate, and you just kind of assume, hey, I'm doing the right thing, I'm on track. But a 3% default rate, it is mathematically guaranteed to fail when you're trying to fund a 30-year retirement. It's giving people a totally dangerous false sense of security.
And this brilliantly illustrates exactly what we're talking about. You've probably seen the financial headlines throwing around the average 401k balance for people over 65, usually saying it's somewhere between $270,000 and $300,000. But man, averages are so deceptive. That number gets completely dragged up by a tiny, ultra-wealthy 1% with multi-million-dollar accounts. If you want the intellectually honest truth about the typical worker, you gotta look at the median. Meaning exactly half have more and half have less. And that median reality, it's just $88,000 to $95,000.
So what does an $88,000 nest egg actually buy you when you stop working? Well, if we use the classic 4% withdrawal rule, which is designed to make your money last 30 years, you're looking at a shockingly low $3,500 to $4,000 a year. Let's just ground that in reality for a second. That is not a monthly income. That's for the entire year. $3,500. That barely covers a couple months of groceries, or maybe one minor, unexpected medical bill. It is absolutely nowhere near enough to sustain a standard of living over 3 decades, especially when you factor in inflation, rising healthcare premiums, and the whole Social Security shortfall situation.
Part 2, the hidden engine. To figure out why these balances are so staggeringly low despite decades of steady work, we really need to look under the hood and truly understand the underlying mechanics of the system.
We kind of need to completely redefine what the 401k actually is. Systemically, it's not really a benevolent retirement safety net. It's a highly efficient risk transfer engine. It is literally optimized to harvest fees passively. The entire setup, the default funds, the employer match that acts like golden handcuffs, it's all designed to keep you locked inside their ecosystem. And honestly, it is functioning exactly as it was designed to. It efficiently pumps out durable, recurring revenue for the financial sector while dumping the massive, complicated burden of asset allocation right onto the shoulders of everyday retail investors.
The big, monumental shift in our modern society was this structural transfer of risk. Think back to the old defined benefit pension system. Back then, the employer took the hits, If the stock market tanked the day you retired, your pension still paid out your exact promised income. But the modern 401k flips that entirely onto you. You are now the one carrying sequence of returns risk, meaning if the market crashes on your retirement day, your future income is permanently wrecked. You also carry the longevity risk, that terrifying fear of just outliving your money. All the while, the financial institutions, they keep collecting their administrative fees no matter what the market is doing.
Let's break down how those fees actually extract your wealth layer by invisible layer. First up, you've got AUM, Asset Under Management Fees. Wall Street takes a cut of every dollar, usually between 0.17 to over 1% every single year. Then, the plan administrators slap on platform fees. But the craziest part? The deepest mechanic is something called revenue-sharing kickbacks. It's essentially a legalized pay-to-play system. Mutual fund companies literally pay the 401k record keepers a cut of their fees just to get a spot on your company's investment menu. This totally forces people into expensive, actively managed funds just because those funds pay the highest kickbacks. Industry data actually shows the average participant bled about 0.52% of their total assets to these fees in 2022 alone.
Part 3. Real-world wealth leaks. Now that we see the engine, let's look at the human element. We're going to track exactly how these systemic pressures silently bleed your compounding wealth over a career.
This is where things get genuinely tragic. Let's look at a typical 20-year career where someone changes jobs, say, every 5 years. And every time they leave a job, instead of rolling their 401k over, they cash it out. By doing this, they are continuously resetting their compounding clock back to zero. And you have to understand, compound interest is massively backloaded. The real, explosive, life-changing gains, those happen in years 20 through 30 of an investment. By constantly starting over from scratch, this worker completely misses the exponential wealth curve. They're just perpetually stuck riding that flat, linear beginning.
Now, you might be sitting there thinking, who actually does that? Nobody self-sabotages like that. But a massive 2022 academic study of over 160,000 workers found that 41.4% of them completely drain their retirement accounts when they switch employers. Over 41%. Why do people do this? Well, it's mostly driven by a combination of immediate financial stress and just not fully grasping the catastrophic long-term cost of pulling that money out. Because the math on this leakage, it creates an immediate absolute tax bomb. The second you cash out early, the IRS smacks you with a 10% early withdrawal penalty. But it gets worse. That entire cash out is added on top of your regular income for the year. That spike can easily shove you into a much higher tax bracket. By the time the IRS is done taking its cut, you could easily lose 30 to 40% of your nest egg right off the top before the money even hits your bank account. Poof. Years of hard-earned tax advantage growth just evaporated in an instant.
Now, what's really interesting about this slide is the totally invisible killer, fee drift. It's basically compound interest working in reverse against you. Let's look at a case study of a middle-income couple nearing 65 with a $1.3 million 401k. Because their plan is stuffed with those expensive mutual funds we just talked about, they're underperforming a basic low-cost index strategy by just 0.5 to 0.8% a year. It sounds like nothing, right? 0.5%? But you're not just losing that 0.5% today. You're permanently losing the future compounded growth that money would have made over the next 20 years. Over 2 decades, that tiny little gap cost them between $300,000 and $600,000 in foregone wealth. That is up to $500,000, just gone, completely invisible to the participant.
Part 4. The Elite Playbook. Okay, so the system is fraught with behavioral leaks and hidden fees, but there is a way out. Let's shift gears and reveal the exact strategies that wealthy, elite investors use to bypass this whole trap.
So the crucial point is really captured in this quote from our source material. The 401k is not a wealth-building product. It is a fee-generating risk transfer chassis whose primary business outcome is durable, recurring revenue. If you want to win, you absolutely have to adopt this mindset shift first. Stop looking at your 401k provider like there's some benevolent partner watching out for your golden years. You have to start viewing them as a vendor, period. A vendor whose costs must be ruthlessly managed and audited.
For elite investors, the real advantage isn't about trying to pick the next hot stock. It's about aggressively controlling 4 specific hidden variables. Number 1, minimize fee drag. Target aggregate fees of less than 0.2%. Number 2, prevent leakage. Make a hard commitment right now, never cash out, always roll over. Number 3, avoid behavioral slippage. This basically means holding your ground and ignoring the urge to panic sell during an economic downturn. And number 4, the real game changer, master asset location arbitrage. It's not just about what you invest in, it's about exactly where you put it. It's like playing chess with the IRS, intentionally putting your fastest growing assets in tax-free Roth accounts and hiding your slower tax-inefficient assets in your standard pre-tax 401k to massively lower your lifetime tax bill.
Let's move to and see how this all builds into the ultimate architecture. Wealthy investors do not rely solely on the 401k. They treat it as just one single tile in a much larger multi-tile retirement stack. Step 1, keep a super low-fee core of basic index funds in the 401k just for tax efficiency and to grab that employer match. Step 2, build up a standard taxable brokerage account so you actually have some liquidity. Step 3, and I love this one, use health savings accounts or HSAs as stealth retirement accounts. HSAs are literally triple tax advantaged. The money goes in tax-free, it grows tax-free, and it comes out tax-free for medical expenses or simply acts like a traditional IRA after age 65. Finally, step 4, building Roth conversion ladders. This means systematically moving pre-tax money into Roth accounts during low-income years, so you pay minimal taxes now and pull it out totally tax-free later in life.
We've covered a lot today. The startling reality of those median account balances, the hidden mechanics of risk transfer and fee extraction, and the elite playbook you need to bypass the trap. Which leaves us with one incredibly provocative question to ponder next time you look at your own portfolio. Are you building your own retirement, or are you just funding Wall Street's? Get out there, take control of your variables, deeply scrutinize those fees, and start building your own multi-tile stack today. Thanks so much for joining me on this deep dive in the Explainer. Keep learning, keep questioning, and I'll see you next time.